Keynesian economics was developed in the 1930s by John Maynard Keynes in the period of the Great Depression. It is an economics model that maintains that an economic output is greatly influenced by the total demand in the economy. This means that the aggregate demand and spending in an economy has impacts on the output as well as inflation in the economy. In this video, we will talk about this. Before we continue our video, make sure to subscribe to our channel and hit the bell icon for more videos. Overview of the basic principles of Keynesian economics. Keynesian economics is a form of macroeconomic theory that is based on the ideas of the British economist John Maynard Keynes. It is focused on the role of government in managing the total demand for goods and services in the economy in order to maintain economic stability and full employment. Keynesian economics advocates for government intervention in the economy through fiscal policy, such as taxation and government spending, to stabilize aggregate demand and ensure economic stability. This theory also emphasizes the importance of aggregate demand and the use of government stimulus to kickstart economic growth. Keynesian economics is still widely used today as an important tool for policymakers to help manage and stabilize the economy. Keynesian economics and the business cycle. Keynesian economics, named after the British economist John Maynard Keynes, is a theory of macroeconomics that focuses on the role of aggregate demand in determining economic output and inflation. Keynesian economics suggests that governments can positively influence macroeconomic outcomes by increasing or decreasing government spending and taxation. This fiscal policy is used to promote full employment and stable prices. In addition, Keynesian economics suggests that the business cycle is caused by fluctuations in aggregate demand, which can be offset with fiscal policy. This theory has become an important part of modern macroeconomics and has been a major influence on economic policy in many countries. The role of government in Keynesian economics. Keynesian economics is an economic theory developed by British economist John Maynard Keynes in the 1930s. It focuses on the role of government spending and taxation to help manage economic cycles and combat economic recessions. According to Keynesian theory, government intervention in the form of increased spending and tax cuts can help stimulate a sluggish economy and reduce unemployment. This is achieved by increasing the rate of aggregate demand for goods and services and raising the level of economic activity. Government spending and taxation also play an important role in helping to stabilize prices and promote long-term economic growth. The impact of Keynesian economics on inflation and unemployment. Keynesian economics is a macroeconomic theory developed by John Maynard Keynes in the early 20th century. The theory is based on the idea that
government intervention and spending can help stabilize the economy and reduce the impacts of recessions and depressions.
Through this theory, governments can increase or decrease spending and taxation to influence the level of economic activity, which helps to reduce both inflation and unemployment. This theory has been particularly influential and has helped to shape the economy of many countries around the world. Fiscal policy and monetary policy in Keynesian economics. It is based on the idea that government intervention can help to smooth out economic fluctuations and ensure economic growth and stability. Keynesian economics is implemented through both fiscal policy and monetary policy. Fiscal policy involves the use of government spending and taxation to influence the level of aggregate demand in the economy, while monetary policy uses interest rates and the money supply to influence economic activity. Through the use of both fiscal and monetary policy, Keynesian economics advocates for government intervention in markets to ensure economic stability and growth. While the theory has been challenged in recent decades, it still remains a powerful and influential economic tool. Advantages and disadvantages of Keynesian economics. Keynesian economics emphasizes the need for government intervention and spending to stimulate economic growth. Keynesian economics advocates for increased government spending during recessions and depressions recessions, as well as lower taxes in order to stimulate consumer spending and help businesses remain profitable. This type of interventionist policy is often referred to as fiscal policy. Keynesian economics also supports the idea of counter-cyclical fiscal policy, which includes increasing government spending during recessions and decreasing it during periods of high economic growth. The main advantages of Keynesian economics are that it encourages governments to intervene in the economy to help prevent and address recessions and depressions. Additionally, Keynesian economics provides a rationale for increased government spending on public works and other programs that can help the economy. The main disadvantage is that Keynesian policies can lead to government debt and deficits, which can be difficult to manage and can create long-term problems. Historical origins of Keynesian economics. Keynesian economics focuses on the aggregate demand of an economy and its effects on output and inflation. It stresses the importance of government spending and taxation as tools for managing economic activity and emphasizes the role of aggregate demand in determining economic output. According to Keynesian economics, when aggregate demand is weak or inadequate, the government can boost demand through expansionary fiscal policy, such as increasing government spending and cutting taxes. This would lead to increased economic activity and thus higher employment and output. On the other hand, when aggregate demand is too high and inflation is rising, the government can cool demand with contractionary fiscal policy, such as reducing government spending and raising taxes. Criticisms of Keynesian economics. Keynesian economics is focused on the concept of aggregate demand, which is the total amount of goods and services that consumers, businesses, and the government are willing to buy. In order to increase aggregate demand, Keynesian economics suggests that governments should take action to reduce taxes, increase government spending, and increase the money supply. This can help to boost economic growth and reduce unemployment. However, Keynesian economics has been subject to a number of criticisms, including the idea that the government's intervention can lead to an increase in government debt and can cause inflationary pressures in the economy. Modern applications of Keynesian economics. Keynesian economics argues that government intervention is necessary to help economies recover from a recession. It also emphasizes the importance of aggregate demand when it comes to economic growth. The theory is based on the idea that government spending and taxation can be used to influence aggregate demand, thus stimulating economic growth. This is in contrast to classical economics, which argues that the economy should be left to its own devices. Keynesian economics has been used to address many economic problems, including the Great Depression of the 1930s. It has also been used to explain the current global economic crisis. Governments around the world have used Keynesian policies to stimulate economic growth and reduce unemployment. These policies include increasing government spending on infrastructure, reducing tax rates, and increasing government spending on education and social programs. Governments have also used monetary policy to influence aggregate demand by manipulating interest rates. These policies can help create jobs, increase consumer confidence, and reduce income inequality. So this was all about the video. For more videos, make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a great day.